Hi everybody. We are here to understand the various concepts stipulated in the International Financial Reporting Standards. These standards have been widely used in order to prepare an entity's financial statements. So let us start and understand the various concepts. I will be launching a series of videos in order to explain these concepts. So you might be wondering as to why was there a requirement for setting up financial reporting standards. Let me clarify this with an example. Take for example, there is a company X and company Y, both in the industry of manufacturing electronic vehicles. Now, company X financial statements can be compared to company Y's financial statements if and only if both follow similar accounting practices and accounting policies, right? So, in order to bring uniformity in the financial statements of various entities, these standards have been set up. Now, who sets up these standards? These standards have been set up by a board called International Accounting Standards Board. The board is domiciled in United Kingdom. Now I will start by way of explaining you the various components of the financial statements. Suppose a person gives to you a financial statements of prepared under IFRS. They briefly have five components as mentioned. One being statement of financial position, two being statement of profit or loss and other comprehensive income, three being statement of changes in equity, four being statement of cash flows, five being explanatory notes. Now, let us go inside each and every component in order to understand what kind of things are being portrayed and what will be the key definitions which we have to understand for all our future videos. Firstly, statement of financial position. Statement of financial position is nothing but it is a balance sheet of an entity which consists of the assets and liabilities. So, as you can see, this is typically a balance sheet asset side of an entity. If you try to focus, there are two key terms. One is current assets, another is non-current assets. What are current assets and non-current assets? Current assets have been defined in the standard, and non-current assets are nothing but everything other than current assets. So firstly, we need to understand what are current assets. Current assets are nothing but they are the assets which the entity expects to realize in its normal operating cycle, or they are held primarily for the purpose of mere trading, or the entity expects to recover them within 12 months from the end of reporting period, or they are nothing but cash and cash equivalents as defined in another standard. So what is defined in the other standard that I will be covering when I discuss the standard called IAS 7. Now here we observe another key term, that is normal operating cycle. As I mentioned earlier, an entity classifies an account balance as current if it expects to realize it in normal operating cycle. Now what is normal operating cycle? Normal operating cycle is nothing but it is a time frame required for an entity to purchase its assets, sell the assets and realize cash. So from the start point of uh, purchases, then it goes to so-called production or rendering of services, then the final stage is receipt of cash. So the entire time frame required for this to settle down is nothing but normal operating cycle. So if you see, if you just concentrate as to certain account balances which are reported under current assets, you find something called inventories, something called trade receivables. Why do you think these are typically classified as current assets? Because see, as I mentioned earlier, when an entity purchases certain assets, they will be classified as inventories, right? So inventories are nothing but they form part of our normal operating cycle. Then when the inventories are sold, they get converted into trade receivables. So trade receivables are also nothing but they form part of our normal operating cycle. Then trade receivables get converted into cash. So typically the time frame required. So even if even so here the peculiar point to note is, even if the normal operating cycle is beyond 12 months, the asset balances will be classified as current only. You might be wondering, where exactly do I require, do I see the normal operating cycle beyond 12 months? Suppose you are into an industry which manufactures alcohol. They actually require beyond 12 months in order to have the finished product and fetch cash for the finished product, right? So in that case, even though it is beyond 12 months, we have to classify it as current. So usually now, let me put it like this: the fundamental is that inventories and trade receivables usually form part of your normal operating cycle and thus needs to be classified as current. Rest everything, the the standard tells us to classify the same as non-current, right? Now here what you see now is nothing but a liability side of the entity's balance sheet. Here as well you find something called non-current, something called current, right? These definitions are nothing but the vice versa of the current assets and non-current assets. So in case of current assets, we see that the entity has to realize its assets in normal operating cycle. Here, the entity has to settle the obligation in the normal operating cycle. So what could be an example for that? Trade payables. In case of trade payables, when we purchase some items, there will be trade payables which get recorded. Now, the trade payables get settled as part of normal operating cycle. So hence they will be classified as current, right? So apart from the current and non-current, we find something peculiar called equity. What is equity? Equity is nothing but they have a residual interest over the net assets. How do they have residual interest over net assets? For example, you assume you are a shareholder of a company X. Now, what is the interest that you have in company X is nothing but the interest of its net assets. Net assets are nothing but total of assets less external liabilities. All the external liabilities will give us net assets. Now, you as a shareholder will be more of interested in the net assets because at the time of liquidation, a portion of net assets, or rather based on your percentage of shareholding, the portion of net assets comes to you, right? So that is the reason they get classified as equity, since they have residual interest over the entity's net assets. And typically the other equity is nothing but it is the accumulation of the entire profits what the entity has earned till date. Now here let me explain you a peculiar guidance which the standard gives us in place of borrowings. Now for borrowings, whether in order to classify them as current or non-current, one must focus on how best the entity is able to comply the covenants. Covenants are nothing but they are the conditions which are mentioned in the loan arrangement. So if at all entity breaches any covenant and the breach of covenant leads to the lender having a right to claim the entire amount of loan which was lended to the entity, then it is very important for us to focus on its classification. Now here the trigger is breach of covenants. So what happens when a breach of covenants happens? Let us follow this flow chart in order to understand. So we need to evaluate as at reporting period end. Reporting period end is nothing but the period end date as in which the entity's balance sheet and financial statements will be presented. So usually for an entity which follows calendar year, it would be as at 31st December, and which follows a financial year, it would be 31st of March. So as at reporting period end, or by then, that means either before reporting period end or as on reporting period end, the lender communicates to the borrower that, or rather the lender communicates to the entity that I am able to give a grace period for you to make good the breach what you have done, and the grace period shall be beyond 12 months. If this criteria meets, then the entity is good to have the classification as non-current, else it will be current. Now you might be wondering what kind of covenants breached will lead to will lead us to introspect and follow this flowchart. For this, one must read the entity's loan arrangement with the lender. In case of a few clauses, there might be a mentioning that if if a repayment which falls due and is not paid within a stipulated grace period of say 30 days or 90 days, then the lender has an absolute right to claim the entire amount which has been financed. There could be such kind of stipulations, right? So when entity breaches that amount which falls due, then it could have a chance of getting the amount financed to be classified as current rather than non-current if the criteria mentioned is in this flowchart is not met. For in order That's all for current session, guys. So for the other components, I will be presenting you in subsequent videos. That's all from my side for today. Thank you so much.